Okay, welcome everybody. It's Ari Rosenbaum here. Another episode of that 401k Virtual Bunch. John Russon is my guest, CPA from Pension Assurance, and he's doing it from his car, which is very, very unique. It's a very nice car. You know, if they didn't have my Prius V today, that'd be a whole nother story. I did have to get 2 new tires today because apparently my car has got like a magnet in its tires to nails. John, how are you?
I'm doing fine, Ari. How about you?
Can't complain. How's the weather out there? Because you're based out in
Great.
California, Southern
Yeah,
California, the better part,
yeah,
in my opinion.
it's in the 80s. Nice.
Oh, Mike Webb wants to know what kind of car is it?
Uh, Audi all-road.
Okay.
Yeah, I'm pretty active, so the station wagon helps. I like to throw my dive gear, surfboard, or whatever in the back, and yeah.
Well, JD Carlson from JD Carlson's a big.
Oh yeah, yeah. He's a
yeah. We could
yeah.
Every time he does a lot of the zooms that he does, you'll see the surfboard in the back.
Oh yeah. He's much more of a surfer than I am. I'm more longboarder, and when I find the time.
Sure. So how did you start out? You know, of course, the running joke people always ask me is, Ari, how'd you become an ERISA attorney? And my answer was always, it's the first job I ever got. You know, I had a tax LM. Some guy was looking for ERISA attorney, $35,000 a year in 1998. I thought I was, you know, wealthy, you know. How did you start out?
So I started out, I was auditing and accounting was just going to be kind of I'm going to learn the fundamental basics of how businesses work. And then I think I always had a little bit more of an entrepreneurial, spirit. And so that was kind of my plan, is to learn how businesses work. But, I got a few years into it and really gravitated towards 401k plan audits. I spent my summers doing that and I enjoyed it. And then I think the entrepreneur in me said, hey, there's a gaping hole here with like a lot of firms that just treat this as, filler, summer, not focused on it. It's not a big revenue for the firm. And so I kind of saw an opportunity there, and I enjoyed the work. And so the business I started actually was an audit firm, which was the last thing I would have thought of when I first started. So that's kind of how I got into it. It was just one of the many service lines I would work on each year at the full service accounting firm I was working for at the time. And, I saw a good opportunity that I enjoyed, and I knew there was a need. So that's how I started.
What was the time frame between starting out, getting the CPA, or just starting out as an accountant and then starting your own practice? How many years?
So I think this is where it's pretty unique, especially in the accounting world. You talk about path to partner, 12 years maybe, I actually started my firm 3 years out of college. So I got my CPA license 2 years out of college. Sorry, another call came through. I got my CPA license 2 years out of college, did another year, and then just decided, okay, it's time. I want to do this. I knew I didn't really see much of a future at that firm. And so I was 3 years out when I hung up my shingle and went out as John H. Russon, CPA, 401k plan auditor.
Wow. So 3 years in, because it took me, probably about 12 years to get the nerve to go out on my own. It's pretty amazing.
It was a slow start. It definitely was an overnight success. And a lot of people didn't take a 28-year-old very seriously. And, I knew I knew more than most when it came to 401k audits, because I just gravitated towards it and I studied it, and I really wanted to turn off everything else and just focus on that. But it was still a struggle at first, but, it was no regrets. That's for sure.
How do you market yourself? Because, again, I was an ERISA attorney, and I knew that, when I worked at a law firm, I could get our law firm clients to hire me because we had partners who kept their clients, like, it was like the secret formula of Coke. How did you get clients? For me, it was advisors and TPAs. How did you go about getting, starting scratch as a 28-year-old?
Yeah. So, I had a pretty strict policy. I wasn't going to take any clients from my old firm. I knew that they would bury me if I tried to, so I didn't even go for it, So I didn't do that, but I had some relationships, some wholesaler, TPA advisors. But actually, I worked part-time at a direct mailing house when I was in college. So from there, I really learned how direct mail works and database and, 401k audits. And that was part of when I started to do, when just had this business plan to go do this. I thought, you know what, EFAS is public, right? All my two shout outs are Judy Diamond, which is now something else, but I still call it Judy Diamond, and Aristopedia. And so I use those databases, at least at the beginning, I was using them a lot. And it was,
and they actually work because, I sponsor plans over the years, MEPs and all that stuff. And I get the letter from the advisor who just obviously picked me up from the EFAST, and that actually works. I mean, what's the success rate that you had?
Initially it was pretty high because I felt like I was the only one doing it at first back in like 05, 06. I was doing postcard mailers, cold calls, and I was converting pretty good. I mean, for like maybe like a $2,000 to $3,000 investment on marketing with database and product postage and printing and everything, I was flipping maybe 6, 7 audits out of that. So it's a good ROI for sure to start off with. That was losing steam, but fortunately it was losing steam at the same time I was gaining reputation and building a network. And so we still do some, kind of like throwback, like postcards occasionally, things like that. Cold calls, why not? Because I like the team to learn how to do cold calls because they're not easy. And so we'll still do some of that stuff, but now it's all, now we're marketing to CPAs, advisors, and that group, and the true 401k or retirement plan specialists that recognize our value that, hey, this is all we do and we're going to come through and we're going to do it efficiently and we're going to bring a lot of expertise and make the whole process just better and make the plan stronger at the end of the day.
So how'd you transition from John Russon CPA to pension assurance? You went for the branding idea, I guess.
Yeah. So, the practice it's always kind of been the same practice with the same ideology, more or less. I've definitely learned over the years, but it's just me. I did that for a year. I only did it for a year because it is a little bit scary being a young CPA out on my own doing audits. I mean, tax work is maybe a little bit different. You're doing your friends and family's tax returns. Right. It's different to go out and talk to CFOs at medium to large size companies and, and plus, accounting rules and auditing rules were starting to tighten up, and they've tightened up more and more. Like I look back now and I go, that it would be crazy for me to do what I did 15 years ago now.
Yeah, before Sarbanes-Oxley and all those restrictive rules.
Yeah, peer review, audit, all the scrutiny on our industry right now. So, it was fortunate timing, I guess. But so I look at all that and I look at, so I got a year into it and I thought, fortunately I met up with one of my friends that I worked at a firm with before. I actually used to work at Arthur Andersen, so we'll throw that out there and put that on the table. I only worked there for one busy season because I actually started right when it was making front page news because of the Enron scandal. So I walked into it, didn't know what was going on, lasted about 4 months, and that was it. I was out. And but I one of the managers at the time there, he ended up starting his own Sarbanes-Oxley consulting firm, and then we found each other in 06, and I merged my benefit plan audit practice into that, and the name of that firm was CNM.
Okay.
And so I was, a partner at CNM. I'll plug this in because it's not giving me good visibility. I apologize. Okay. So I was a partner there for 8 years. And, I was growing it there. I was kind of doing everything I wanted to do, got up to about 125 plan audits, team of 8. Great. We were doing quality work. I look back now and it was like, we've learned so much more since then, but at the time we were doing really quality work. And then, I got 8 years into that, almost 9 years. And then I started realizing like the same struggles I had as a senior accountant auditor, kind of moving in and out of different service lines was, now I'm seeing my team go through that. They're moving in and out of tax. They're doing benefit plan audits for 4 to 6 years during the, 4 to 6 months during the year. But then they're moving to other service lines, and that's very distracting, and it's very hard to really become an expert when you're doing the multi-service model. So anyways, I decided, hey, you know what? Here's the next evolution in this thing. We're gonna not only are we gonna be specialized in the practice and me, the firm is gonna be specialized in benefit plan audit. So, and November 1st, we just hit our 6-year anniversary. November 1st, 2014, we spun out of that firm and we created pension assurance. And so now this was different. This was a single service accounting model. It was, we're going to do one thing. We're going to try to be the most efficient at it. We're going to try to be the top experts in it. And that's all we're going to do. And that's all the team's going to do. And that's going to be the full focus of the firm. Even our mission statement and vision statement is going to have the word retirement plan or something in there because we want to be that focused on this thing. So that's kind of the evolution of pension assurance. Like I said, it wasn't overnight. It took a while. We're on a good roll now, but it took a long while to build the foundation for it.
Yeah, before you got on a little bit early, and we discussed it, and how many different, here's the anomaly is I'm an ERISA attorney. It's a federal law. I have clients around the country. While I have bar admission in New York, California, Massachusetts, I can practice anywhere else. You guys as CPAs don't have that luxury. I think the reason why is because attorneys get away with murder. You know, they set the rules and guidelines. But which states are you allowed to practice? And, you know, because that is something over the last few years I've noticed that the state CPA, licensing have been going after out-of-state auditors.
Yeah. So it was an interesting thing that happened. This was probably 8 years ago. Is somebody caught on. I actually think it was the DOL chief accountant Ian at the time. They caught on to say, how can we find bad auditors? And so they realized, like, hey, all we have to do is match up state license databases against a EFAST, and we can find out who's practicing in states they shouldn't be, and that's an indication that maybe that's a bad auditor. And prior to that, people didn't really care so much. It wasn't like a big deal. But then actually the DOL kind of made it, at least in our industry, they started sending out notices to plan sponsors. Hey, your auditor's not registered in your state. And everybody I talked to got caught up in it. We were all practicing in a state, because CPA mobility was still a very fluid concept at the time. And we were in that mode of transitioning, I think a decade ago, of really that remote work where we're not like on site that much. That was kind of really taking off. And so states weren't really sure how to, like, hey, well, if they're not coming into the state, do they need to be licensed? So they kind of started making, rules. And at first, most of the states said, yeah, even if you service a client that's in our state, we want you to register and we want our money, right? They wanted their fee. And so the DOL really nudged that. So, it became a scramble. Every CPA that I talked to was going around and getting certified or registered in different states. A lot of states have toned it down because they realized, like, we don't want California denying our state licensees and vice versa. So there's currently, I would say the majority of the states just allow you to practice as long as you're in good standing with your own firm. There's still for us, I think we're about 15 or 16 states approximately that we actually have to go and license. We have to go and.
But you guys just have to pay the fee, or you actually have to sit for.
No, we don't have to sit. No, we have to pay the fee, and we have to file the paperwork. We have to, in a few states, we've had to actually get a in-state licensee. So one of us have had to like I'm a licensee in Massachusetts, California. I actually kind of dodged most of them. Some of my partners are like 3 or 4 states.
Right.
So there's been a few states where we actually had to go get our own license. We didn't have to sit for the exam. We got reciprocity, so we were able to, show that we had the experience and met the eligibility, and we were able to get it. But there's another set of fees and things you got to maintain and submit CPE for. So it's a little bit of a headache. I'd say CPA mobility is, it's not the funnest part of the job, but it's part of the job. We got to make sure we can practice in each state, and we do that before client acceptance. We have to.
Yeah, I think if I wanted to move to Florida and become a Florida lawyer, I actually would have to sit for the exam. And it's like after 3 exams, California being the last one and passing all of them, I don't want to take another exam. It's been 22 years since I took one. So you just have the office in California, or because? Okay.
Yeah, we have 2 offices, one downtown, which we opened up about a week before COVID, maybe 3 days before COVID.
Oh, that's a lot of fun.
I don't think we've even moved into it. I don't even think there's furniture in there. I've never been down there, but one of my partners kind of uses it for quiet time when he needs to do work. But otherwise, we got a downtown office, and then we have a San Fernando Valley office. So we're basically in LA. We've got some remote people that work around that aren't necessarily in LA, but just the 2 offices.
How has COVID impacted the practice? Because, I mean, has it really? Because now it's so much remote. Usually, the old days, it wasn't so remote. It was, they would actually show up at the office and get everything because, it was a different time, especially with technology. But did it really impact you guys for October 15th or?
Yeah, it did. I'll talk about COVID. I just saw a comment that said now I have a car office too, which I've done more than in my car. I mean, we're doing a remodel in the house. We've been in a rental, and I got kids that play instruments. It's been interesting. Fortunately, everybody's pretty gracious with COVID right now, so they let me get away with turning my car into an office, which has happened more than once. But yeah, COVID. And at first it really, I was scared. I mean, cash collections, what's going to happen, bankruptcies. I mean, everybody was scared, right?
Yeah.
We took a pretty strong position because I didn't really want the team, to fill it too much. There's a website called Going Concern for accountants, and it kind of tells you what all the accountants, like a blog, and all the accounting firms, they check in and see what they're doing. Layoffs, pay freezes, pay reductions, all this stuff. We just held strong because I knew sales wasn't going to be an issue for us. Fortunately, we've gotten to a point where, we hit our sales numbers. We usually end up turning away some work. I knew that wasn't going to be the issue. Fortunately, I was hopeful it wasn't going to be the issue. Cash collections, on the other hand, scared me. Last year, almost about a year ago, we actually tightened up our cash collections to say we will not issue the financial statements until we have final payment. We just got so sick of chasing AR well after October 15th when nobody wants to talk to a 401k auditor. And, so we just made that policy. Lucky because we were fine. I mean, we could, we could basically tell people like, hey, we'll get the audit started. Just know that we can't finalize it and issue financials until we get that final payment. And most people were understanding. We made occasionally we had to make a few exceptions here and there, but very rare. So from that standpoint, great. We had 2 companies or maybe 3 that filed for bankruptcy, reorg. So it wasn't the end of the world. Headcount reduction is a real thing though. So fortunately, that's not going to affect us this year or even next year because the measurement date on January 1, 2020 is what's going to drive the 2020 audits, which we'll be performing next year. Those will still be all large plans. Now we're going to have to look at what kind of headcount reductions were permanent and, who's going to be falling under the audit requirement going into 2022 for the 2021 audit. So fortunately, we can keep an eye on it. We'll know ahead of time and we'll know how to correct. But we actually had record sales and ended up being a really busy and okay year. We have a lot of technology companies. They had their best years ever. So, hopefully this is the extent of it. We'll see.
The audit game, as they say, I call it a game. There's misconceptions about what a retirement plan audit does and what it doesn't do. And I off the top of my head, what it doesn't do is, it never really talked about costs, never talked about excessive fees and whatnot. They're just a major misconception from advisors and TPAs as to what an audit really does and what it really doesn't do.
Yeah. And even within auditors, there's still some misconception as well. And the DOL would like it to be more of a compliance audit, which it isn't. And auditing standards are very clear that we do financial statement audits,
right.
Materiality thresholds and all that. But it does. There's actually a pretty big compliance component to these audits that there otherwise wouldn't be other than people expect it. And, DOL, Department of Labor expects it. And, and there is some trickle effect that could ultimately have an impact to the financial statement numbers or at least disclosures. But yeah, it's a financial statement audit. So we're given an opinion, and 90+% of the time we're actually declining the opinion and issuing a limited scope audit, which, everybody should be aware of. And I know you're aware of that. And that's when, whoever holds those assets, whatever custodian or insurer or trustee, that they're a qualified institution. And so that means they have some kind of state, federal oversight or audits, regulations.
They can self-certify their trust statements.
Yeah, so they can certify it. And that saves, 6,000 auditors from having to go and recalculate what, I used to use the PIMCO total bond return fund, but I don't think that's a big one anymore. Hasn't been for a while, actually. But that would save a lot of auditors from going and recalculating some the same mutual funds over and over. So it's really earnings, market valuation on investments. That's what's excluded out of the limited scope. But because of that, we can't issue a unmodified, we can't issue a full opinion. We have to actually disclaim an opinion and based off that scope limitation. But otherwise, we're looking at all the participant and employer initiated transactions. So, participant loans, enrollment, contributions, distributions. We have to look at all of those transactions in and out. It's compliance to the point to where, there's no systematic issues where like a correction would cause a material misstatement to the financial statements, right? So we are looking at, we're comparing it against the plan document to make sure definition of comp is always huge, and that one can be a nightmare. We had a client last year facing a $700,000 plus correction.
Yep.
Yeah. So, and when you get into these issues, I mean, your best friend's your risk attorney. I mean, honestly, and you've probably got stories for days of, and you got to get that reviewed by a risk attorney and make sure that, because a lot of times you can get out of it. And a lot of times there's some wording in the plan doc that will, now I'm speaking for you, but you can speak to that. Go ahead.
When we talk about comp, it was always, I told the funny story when I was at Meyer Swazi. They had a client and was referred to me as the ERISA counsel, and one of the big four, was it big four now? Because I forget how many. Yeah. It's big four now. When I went to law school, it was I think big six. Then went kaput, and Coopers and Price merged. So anyway, one of them did an audit for a publicly traded bank, and for 20 years they got the definition of compensation incorrect. They excluded bonuses when it should have been included for employer contributions and deferrals and all that kind of stuff. And of course, it was 20 years, and I said, you got to go to the VCP on this. And of course, they hired probably the only ERISA attorney in the United States who said, yes, you could self-correct it. So I'm, and that's going to segue into my whole thing that, what are the pros to me? Why hire somebody like your firm rather than, a big four? I mean, which is probably softballs of questions, but, why do people still think that if they go to the big four, they're getting something, or even some of the regional powerhouse CPA firms? Why do they go there when they should probably go pick somebody who that's all they do?
Yeah, I'm not gonna give you the easy answer. I'm gonna actually expound on it a little bit. I mean, the easy answer is big four. I mean, they're gonna charge you a lot of money, and they don't have anybody that's really looking at it. They have a couple national people, and it's not a dig to the big four. They do great. If you're SEC, publicly traded company, big four all day. But when you're talking about a much smaller audit that doesn't even make their radar, yeah, and actually we get a lot of referrals from the big four because they don't want to do it, and they love that we're not going to compete with them on any of the other services. So, but yeah, it's interesting because we get a lot of great referrals or a lot of great references. Clients are very happy, especially when they're coming from maybe a different experience where the audit team wasn't as trained up and wasn't as efficient and didn't speak the language so much. We get a lot of that. We actually had one this year that regretted hiring us. Okay. But you know why they regretted hiring us?
Because you asked me questions.
We found stuff. And I mean, we found some pretty serious stuff, non-discrimination tests done wrong that could, you go a few years down the road, and it comes up in an IRS audit or whatever. I mean, now you're talking about possibly a pretty expensive QNEC to correct it, as opposed to, hey, you just got to refund some money to the highly comp. So they're not going to be happy, but ultimately you could, QNECs can get up into the hundreds of thousands of dollars. So depending on the demographic of the plan. So yeah, they regretted hiring us. And, at the end of the day, we're actually going to fire them anyways, because we don't want a client like that, that is intentionally running their plan poorly, or at least not, and we're not police. We don't, and we're very adamant about we're not gotcha auditors. We're not looking, to cause anybody trouble. We're really looking to help plan sponsors just have a good plan, have good operations, good procedures, good internal controls, processes. And so, they can avoid all that, and they can actually sleep better at night, and they don't have to worry when they get a knock from the government. That's our goal, is to, help these plans get in a good place. And so, and if you don't want that, then don't hire us, because, chances are if the plan's messy, we're going to find some stuff, which hopefully people want. So there's that. we're going to be really efficient about it, which I feel like our pricing is still pretty competitive. We're not giving away audits like I probably did when I first started. But we're still priced very competitive. So I think our pricing is good. We're not the cheapest, but our pricing is great. But at the end of the day, we're going to make like everybody's life much easier because we're going to work directly through those. We know all the websites. We audit like a whole lot. We're auditing 600 plans right now. So we know a lot of the service providers. We know their websites very well. We can navigate, get reports. We're not going to drag people through unnecessary requests and requirements. And, we're going to make that very efficient. But at the same time, we're going to have pretty good conversations about like how the plan's operating and what processes are in place and what processes should be in place. And if there's any errors we're coming across. So we want to make it educational at the same time, but it's that good balance of like, hey, you're probably going to learn something out of this, but we're not going to like make you miserable learning it. We're going to put a nice bow and teach you something and then be out of your hair. So that's kind of, our program.
The October 15th deadline. I talked about it, I think, in a recent podcast. This is another softball question. The October 15th. So, October 15th is probably one of the most tensest days as any type of a retirement plan provider. You got to get that 5,500. So when that last minute audit, who's usually at fault for that?
The last minute audit, I've seen it both ways. I've seen it, the service provider that didn't communicate it. And I've seen plan sponsors that just kick the can down the road thinking like, this is, an audit takes typically about 6 weeks, right? For kind of all the back and forth and everything. I think some people think they can knock it out in a few days and it's not a big deal. It just kind of depends. This year we had a record late filing number. And I mean, we're really good about not letting anybody file late. This year wasn't. I mean, it wasn't really our fault. I think there was a couple plans that we kind of, I raised my hand and said, hey, you know what? We'll cover your penalties. Maybe we got too backed up. And it wasn't that we got too backed up because we got backed up because people were like dealing with COVID and then showing up in like August saying, okay, ready for the audit. It was just maybe we didn't communicate the best on some of these situations. We should have let you know in August, like, hey, you're in a queue and this is what the queue looks like. But for the most part, we were very good about communicating. We did have a number of late filers. A lot of them are because service provider didn't notify them. This year, there was definitely a lot that just said they weren't in a position to even consider dealing with the 401k plan audit until they were sure they were going to either stay in business or at least their operations were stabilized. But the late filing is an interesting thing. Actually, we don't need to get into it now. I was gonna pick your brain a little bit and say, what do you usually, and maybe this isn't something you want on record, but I mean, what is your usual communication to a plan sponsor when they're in that situation?
Listen, you got to give people legal advice and you have to tell them the accuracy of what's going on. But you file, and then you keep on warning them that if you file without an audit, it's not a filing. And if you're going to get that 45-day letter, you got to make sure that you have that audit right and ready. And then there are situations where we've had this past one where we had an auditor give an exception to the audit. Just laid out this huge exception that if the DOL would ever read the audit, they'd probably audit the client because there was I forgot what the glaring issue was. And the auditor, picked it up and said, "This is the issue that we have here." And then I said, "Well, maybe fix it." And then actually, I think it had to do with late deferrals. It was a multiple employer plan, and it was a firm that obviously, which is really up your alley. It was an auditing firm, again, regional New Jersey, and this was their only multiple employer plan. So they didn't know how to handle a multiple employer plan because the multiple employer plan, they didn't price it right. You have to deal with all the adopting employers, and it just became a huge problem. So I think next year the client is gonna be looking for another auditor. But to me, it's like you have to file, and then whatever exception, or if there's no audit, then you're just gonna have to file an amended return and just bite the bullet, as I say. And I've had a situation. I had a client, I got a preferred client where they accidentally, Julie talked about blank pages. they accidentally put their corporate audit instead of the retirement plan audit when they upped it on the system to file electronically. I mean, it happens. So, the Department of Labor is more forgiving than probably it should be, but it is forgiving.
Yeah, I mean, that's,
yeah.
I was going to say, I even had Marcus Aaron from the DOL. He was doing a presentation. This was maybe like almost 2 years ago for, Western Pension. And he was talking about, hey, from our standpoint, you file the most accurate 500 you have. So we don't recommend not filing and trying to do VCP afterwards. We recommend filing, because that's what actually the Department of Labor said.
Right.
And then, you'll amend that filing. And I think it sounded like to me, if you can beat their penalty timeline, then you're usually okay. And that's been our experience. Of what we've seen is you get the 45-day notice to correct, right? Then they even give you a 30-day notice.
That's correct.
After that.
Oh, but I don't live to see that letter. I make sure not to see that letter. I don't see that letter.
No, you get 45 days. You use those 45 days. You get on. Yeah. 6 weeks. That's plenty.
Of course, the client always sits on it for 2 weeks. Got lost on somebody's desk. You never get it, or I always like when you get a notice from any type of government entity and it says you get 30 days from the date of this notice, and the date on the letter doesn't match what's on the envelope. It's like a week later. It happens. The July 3rd. So going back to the October 15th. So the July 31st to October 15th. That is always really the responsibility, to me, seems always to be the plan provider and the client client, because that's. I hate last minute things. So I don't like last minute. When I do last minute things get screwed up. So the running joke is I took 3 state bars and I never studied the day before. I knew that if I studied the day before, I was dead. So I didn't study the day before and I was fine. So that July 31st, October 15th, that is again fault of the plan provider usually and the client. I mean, why don't they take this stuff seriously? Like, I just don't understand it.
Procrastination, I feel like a lot of people are guilty of it. I don't know. I mean, we're always trying to encourage early. I mean, because we don't have a tax and corporate audit season, March 1st is the start of our audit season. And hey, we'll take them before that too if they're ready. But March 1st, we're already, we already know what service providers are going to have reports ready for us. We're going. I mean, we are in the plan sponsors' ears saying, yeah, let's get to it. Let's do it. So yeah, we're ready early.
One of the things dealing with CPA audits, and of course, for many reasons, I know Ian Dingwall was for many years the chief accountant for the DOL. I think he's since retired. Deficiencies of audits. How big of it? I forget what the report many years ago that I saw about how much percentage. And when you guys present in my conferences, and you guys will be at the virtual event in January, I got to throw in a cheap plug over there. Percentage wise, how many audits has the DOL figured out as deficient?
On their last study, which was released in 2015, it was about 40% were deficient overall. So that's not great odds. You line up 10 auditors, 4 of them are going to be deficient, 6 aren't. I believe it's been increasing. They haven't done an official study or released results for that yet, but in kind of their follow-up and where their regular annual inspections, which they do. I mean, we get our work papers inspected, usually every year, but I don't think we got anything in the last year. But they'll want to inspect it, but yeah, I mean, it's 40% across the board. And then when you get into the spectrums where they started looking at or the stratus where they started looking at what's causing these. I mean, it was overwhelmingly, and we always share that slide, is like the size of the practice has really been driving this. It was for the small. So, and this is very intuitive, with the practices 5 and fewer audits. I mean, you're talking about an auditor that wasn't specialized in multiple employer plans. Think about an auditor who, they're doing like less than 5 audits, right? I mean, benefit plan audits in general. Yeah, I mean, they had deficiency rates up in the 70 to 75% range. So, I mean,
what makes an audit deficient? We talk about deficient audits, but as a CPA, what qualifies as something that's deficient? Why is it so awful?
It's just, it's something that doesn't adhere to the auditing standards. Okay? So there's something within that audit work paper And the DOL might have their own slight interpretation of, they expect to see something, there that wasn't there, right? And usually, I mean, it's got to be fairly, like substantial for them to make that statement. But yeah, somebody's not following the auditing standards, or they're completely missing like a pretty big risk on an audit. Like they're not testing like contributions, right? I mean, something like that, right? Where it's like, like you have to test it because it's on the financial statements and it's always new material almost. So, that when they say deficiencies, that's what they're talking about. So they didn't follow, sometimes it's just they didn't follow auditing standards. Like they didn't do anything on subsequent review of the, so like we're reporting through 12/31/2019, but we're required to look at 2020 statements to see if the plan terminated or changed trustees or something that, would need requirement or disclosure, sorry. So that's what they're talking about when they say deficiencies. And those deficiencies are typically rejectable, and that they have rejected the filings before, right? And then the 5500 gets rejected. And so I know we've taken over maybe 3 or 4 plans that way where their 5500 was rejected and then they were told to get a new auditor. And then the DOL wants to see our work papers too. So it's like, you take those over and you're like, okay, we're going to get audited by the DOL. Let's be on our best behavior. And so you do it,
Many years ago, I knew of a firm and they got closed down by the chief accountant, and it was a whole, the relationship with the CPA. But I think the biggest knock against them was that they had 80 audits done by 3 people.
Oh, yeah.
Yeah, that doesn't really work out, apparently.
I mean, that's, and you think about an audit taking, even on a pretty efficient model like ours, 45, 50 hours, and we're efficient because it's all we do. You're going to probably need more than 3 people to tackle 80 audits, so, yeah.
So Mike has a question. If an audit report doesn't look like all the other reports I see, that it's probably deficient, or it's, maybe short on, facts and maybe 2 or 3 pages, that might be a hint.
Oh, yeah. And if you're talking about specifically the audit opinion, which is that little 2-pager at the beginning, that, and that was a big indicator about 5 or 6 years ago when it changed to a different look, because it used to just be like a 1-pager, and then it went to like a 2-pager because there was more disclosure and more things we had to submit in there. And then you'd notice that because you see some auditors still using the old model, and you're like, okay, they don't know what they're doing. They're not up to speed. So, that was a pretty big indicator. I haven't really run into like any old opinions recently because that was a while ago. But it's pretty easy to pick apart audited financials, and you'll be able to tell like if they're up to date on the latest pronouncements and things like that.
What are some of the horror stories, some of the glaring problems that you discovered in an audit that obviously the client and the plan providers weren't aware of? Because, I always joke, you always need independence from plan providers. Somebody's going to tell you, if you ask your CPA how everything's going, they're going to tell you everything's fine. They have no incentive to be truthful, or they may not be aware. What are some of the glaring issues that you've seen?
Mike just had a comment on that, said embezzlement. No, I haven't seen that. I haven't seen fraud. There's been a few cases where the timeliness of contributions probably could be argued. It's not going to be argued by us, but it could probably be argued by a government official that it was fraud because they were intentionally delaying those payments to the plan. We haven't run into anything that was like for sure fraud. I mean, it's not impossible because we read about it, but it's pretty hard to commit fraud on
Mike, they're only attracted to me. In my career, I've ran into 1 potential client and 2 clients who went to jail for theft of plan assets. So former clients, but they were people I knew,
Yeah. So it's not impossible. It's, fortunately we don't run into it a lot.
I think if you were embezzling money, the last thing you want to do is have a plan audit.
Yeah. I mean, you got so many eyes on these things, that it'd be stupid to try to spill money. And you got, 402G limits and forfeit, you got all these limits and non-discrim tests that are going to be run, right? How much can you get away with? It's like,
that's why I always say if people steal from a plan, I always say you have better chances of putting a pantyhose on your head and going to a bank and robbing it, because at least, there's the chance that they're not going to recognize you. But when you're a plan fiduciary, they're going to figure out, eventually somebody's going to find out that, the money's missing.
Yeah, I would agree with that for sure. No, I mean, the horror stories, fortunately we haven't run into too many. I mean, there's been a few clients we've had to just walk from because, gold coins and other things, and, doctor's plans are, there's always a little touch.
You mean a plan with collectibles? I remember there was one client who had a collectible antique toilet, which I don't know how you value that every year.
Yeah, give us a valuation, like.
And I still don't think that was allowable, because I think, isn't there a restriction on collectibles in retirement plans? But because maybe one of these days I'll start a retirement plan and just buy my graded baseball cards and use that as
yeah. So we've had a few of those situations where they just wouldn't provide valuations, and if it's something that's not traded on the market, we need a valuation. That's the only way to audit that.
And of course, it was I'm sorry, but it was a lawyer it was an antique toilet. I mean,
years of a lawyer. Okay, yeah.
It's a lawyer or a doctor. My jokes about problem clients. It's always a lawyer or a doctor.
That's what we see. And so we get that. And yeah, I mean, we just run into some big definition of comp issues that can be pretty scary.
That is a pretty glaring issue for the VCPs that I've done. Compensation has certainly hit, the top 5, which I'm just amazing. And lately it's something as simple as adopting employers and the date of the adoption agreements for a multiple employer plan. I mean, stuff like that. It's just amazing how many mistakes are made. But yeah, the compensation is the one that, no, Julie, he didn't use the antique toilet. It was for purposes. It's not, not for, he didn't put it into his apartment or something, or his office. But compensation to me is just a funny issue. So we're going to be concluding soon. John, where they can find out more information about your firm and all the different states you practice in and all that kind of stuff.
Yeah, I mean, pensioninsurance.com is our website. You can track us down through there or on LinkedIn. I'm Jay Russon at pensioninsurance.com. Feel free to always reach out to me. I'm happy to answer any questions, anything. But yeah, I mean, we practice in the majority of the states, and if we can pretty much get registered in any state within a matter of weeks. We just have to kind of know ahead of time. So, if it's a new client in a new state, we'll let them know, hey, we're going to go file a permit, we'll run through our CPA mobility matrix to see what we need to do. And then, consider us able to practice in most states, or probably all states. But but feel free to reach out to me with any questions. I'd like to just be a resource.
And you guys will be there in January for that 401k National Virtual Conference, January 21, 22. Sign up before the rates go up on Thanksgiving. And you guys will be there along with Walt Frazier and Doc Gooden. I always have to throw those guys in there for some reason.
Yeah.
So I appreciate and I appreciate your support over the years with the that 401k conference. One of these days we will be back live. We'll see. I thought we would have been back live by now, but as they say where I come from, it is what it is.
So, right. Thank you, Ari. I appreciate you always trying to educate all of us, and you're very active on getting stuff out there and webinars and all that stuff and conferences. So I appreciate that. It's very helpful.
I appreciate your support. Thank you so much. So everybody, if you missed any part of it, it's going to be up on YouTube tonight. So thank you guys for attending. In 2 weeks, we got Cheryl Hickerson, who's the CEO of Females in Finance, which is a great kind of trade organization trying to get females more involved in financial advisory work. So that'll be 2 weeks from today. And that 401k National Virtual Conference number 8 is going to be on the 20th, 12 noon Eastern Standard Time. So thank you, everybody. And thank you, John, again. Take care.
All right. Thanks. Have a great day.